Imagine you wake up, grab your phone, open your banking app, and your balance is zero. Not because you spent it, not because you got hacked, but because your bank went under. What actually happens to your money in that situation? Does it disappear? Or does someone step in and say, don't worry, we've got you? In Canada, that someone is usually the Canada Deposit Insurance Corporation, or CDIC. Around the edges, you've also got provincial deposit guarantee systems for credit unions. In Canada, that someone is usually the Canada Deposit Insurance Corporation, or CDIC. Around the edges, you've also got the provincial deposit guarantee systems for credit unions. Today, I want to explain, in simple language, how deposit guarantees work in Canada, what they cover, what they don't, and why this really matters if you're responsible for big cash balances. So the first question, what is a deposit guarantee in Canada? A deposit guarantee is basically an insurance for your deposits at certain financial institutions. If the bank, that is a CDIC member, fails, CDIC steps in and protects your eligible deposits up to a limit. Right now, that limit is $100,000 per depositor, per category, per member institution, including both the money you put in and the interest you've earned. You don't sign up for it. You don't pay a fee for it. If your bank is a CDIC member and your deposit is eligible, it's simply covered up to that limit. So the simple version is this. If your CDIC member bank fails, CDIC is there to pay you back your insured deposit, usually within a few business days, up to $100,000 per category at that institution. To understand that, we have to talk about bank runs. A bank doesn't keep all your money in a vault. It lends it out, invests it, and only keeps a fraction on hand. If bad news hits and people panic, they can line up and try to withdraw everything at once. If enough people do that, even a basically healthy bank can run out of cash and fail. Deposit insurance is there to stop that panic. If Canadians know that, even if their bank fails, they'll get their insured deposits back up to $100,000, they're not as likely to sprint to the branch and try and pull everything out at the first scary headline. So this isn't just about protecting you personally. It's about projecting confidence in the whole system. Now, let's look at how this actually works behind the scenes. So step one, we have CDIC. It's a federal crown corporation created to protect eligible deposits at CDIC member institutions and to support stability in the financial system. Most of the big Canadian banks you know are CDIC members, along with some trust and some loan companies, as well as federally regulated credit unions. Step two, member institutions pay premiums into a fund. Think of this like an insurance pool. The banks pay, based on their size and risk, to build up this pot of money. If a member institution fails, that fund helps cover insured deposits. CDIC is backed by the federal government, but the first line of defense is the money collected from institutions themselves. Step three, if a CDIC member fails, federal authorities step in. The institution is either closed or restructured in an orderly way. CDIC then arranges a quick payout of insured deposits or transfers those deposits to another healthy institution. The goal is to get insured depositors their money back within days, not months. Step four, depositors get reimbursed up to the limit per category, per institution. And this is where the details really start to matter, especially if you're managing more than a few $1,000s. To make sense of this, we need three key ideas: per depositor, per category, and per member institution. Per depositor just means per person or per legal entity. So you personally get coverage. Your corporation gets its own coverage. Your trust or your RRSP is treated separately depending on how it's set up. Per category refers to specific types of deposits. In Canada, CDIC has several separate categories. For example, deposits in one person's name are one category. Joint deposits, where there is more than one owner, are another. Then there are separate categories for RSP deposits, RIF deposits, TFSA deposits, RESP deposits, RDSP deposits, and deposits held in trust. Each category gets its own $100,000 limit per member institution. Finally, that per member institution means the limit applies separately to each CDIC member. If you have money at Bank A and Bank B, both are CDIC members, you get separate coverage at each one. Let's use a simple example to make this clear. Imagine you're a Canadian with the following at one CDIC member bank: $90,000 in a personal savings account in your name, $90,000 in a TFSA GIC at the same bank, and $90,000 in an RRSP GIC at the same bank. That's a total of $270,000 at one institution. But how much is insured? Your personal savings account is in the deposits in one name category. That $90,000 is under $100,000, so it's fully covered. Your TFSA deposits are in the TFSA category. That $90,000 is also fully covered. Finally, your RRSP deposits are in the RRSP category, and again, $90,000 is fully covered. So even though you have $270,000 at the same bank, because it's spread across separate CDIC categories, all of it is within the coverage limits. If that bank failed, CDIC would protect all of those deposits. Now let's flip the example. Suppose you're a corporation with $300,000 in a basic business checking account at one bank. That's one depositor, the corporation, and one category, deposits in one name. CDIC coverage is $100,000 at that category at that institution. So only 1/3 of the balance is insured and 2/3 uninsured. If a bank failed, the uninsured portion is exposed to loss or whatever deal is worked out in the resolution process. This is where institutional cash gets very interesting. If you're running a treasury for a business, a pension plan, an asset manager, or even a public sector entity, you're dealing with balances that are far above $100,000. You might have tens, even hundreds of millions in operating cash, tax, receipts, or uninvested funds waiting to be deployed. In Canada, you cannot just assume that all of that is protected by CDIC. For institutional investors, deposit guarantees are not a magic shield. They are one tool in a larger risk and liquidity strategy. So how do professionals think about this in plain language? First, they map the insured layer versus the uninsured layer. They ask, how much of this cash is within CDIC limits and how much is above? That tells them exactly where they're taking bank credit risk. Second, they diversify across member institutions. Because coverage applies per member institution, there can be an advantage to spreading deposits across multiple strong banks instead of concentrating everything at one. The $100,000 limit is still small relative to multi-million-dollar balances, but diversification reduces exposure to any single institution's failure. Third, they use different legal entities and categories where it makes sense. A corporate group might have an operating company, a holding company, and a trust. Each of those entities can have its own coverage at each institution, as long as the accounts and the documents are set up correctly. The idea is not to play games, but to make sure real-world structures are arranged in the most protective way allowed by the rules. Fourth, they pair deposits with other high-quality liquid assets. Instead of leaving large uninsured balances sitting as plain cash, institutions often move part of that money into short-term Government of Canada Treasury bills. Those assets can go up and down in price, but they are not tied to the solvency of a single commercial bank in the same way that a big uninsured deposit is. Now we need to talk about credit unions because Canada has an extra twist here. Many credit unions are not CDIC members. They are regulated and insured at the provincial level. Each province has its own deposit insurance or guarantee program for credit unions, and the details are different. Some provinces offer very broad or even unlimited guarantees on deposits at provincially regulated credit unions. Others have limits similar to or different from the federal $100,000 level. So if you're an institutional investor or a corporate treasurer in Canada, you're not just asking, am I at a bank? You're asking, is this institution a CDIC member, or is it covered by a provincial deposit insurer? What exactly is the limit in that province? Is it per depositor, per credit union, and does it claim to be unlimited or capped at a certain dollar amount? Before we wrap up, we should be very clear about what deposit guarantees in Canada do not cover. They generally do not cover stocks, bonds, mutual funds, ETFs, or crypto that you bought through a bank or a broker. They don't protect you from market losses. They also don't protect you from inflation, interest rate risk, or currency risk. And issues like fraud or identity theft are handled under other rules and agreements, not usually under CDIC deposit insurance. Deposit guarantees are narrow on purpose. They focus on eligible deposits at covered institutions when those institutions fail. So big picture, what should you take away from this? If you live or invest in Canada, first, CDIC protects eligible deposits at member institutions up to $100,000 per depositor, per category, per member institution. It's automatic and free, and it's designed to pay out quickly if a member fails. Second, if you are managing larger balances, especially for a business or an institution, assume that a big chunk of your deposits are above the coverage limit. That portion is real risk, and you're basically lending that money to the bank, and you should treat it like exposure at that bank's credit. Third, use the tools you have. You can spread deposits across categories and institutions. You can look at credit unions and their provincial guarantees, and you can combine insured deposits with government securities and other liquid instruments to build a safer liquidity structure. Finally, deposit guarantees are there to give you confidence, not to make risk disappear. The system is designed so that if a normal Canadian saver with under $100,000 per category at a major bank runs into bank failure, they are made whole on their insured deposits. For institutions and larger depositors, the message is understand the rules, measure your exposure, and don't confuse very safe with fully guaranteed once you go above those limits. If you've ever looked at your Canadian bank balance and wondered, is this actually safe? The honest answer is, up to a point, yes. Know that point, use it, and then make deliberate choices about what you do with everything above it.